So before we get into the topic of today's video, I just have to make a couple of things abundantly clear. I am a MacBook board repairman. I dropped out of college because I could not pass freshman pre-calculus or freshman chemistry. You should not be taking financial or investment advice from me. This is not financial or investment advice. And if you do take financial advice from me, you are an idiot. That being said, let's get into the topic of today's video. Hey everybody, how's it going? Hope you're having a lovely day. So today I would like to go over something that has been bothering me about some of the news I've been reading about this bank, Credit Suisse. No, we're going to get to the bottom of this before the video starts.
Credit Suisse.
Credit Suisse.
Credit Suisse.
Credit Suisse.
Credit Suisse.
What?
Credit Suisse.
Credit whatever the F I want to call it. Anyway, we're going to discuss something that bothers me quite a bit when it comes to how this is being covered, because I believe that there are a group of people that have a right to be pissed off, and then there's a group of people that have absolutely no right to be pissed off whatsoever, and I kind of see the news kind of conflating the two together and conveniently allowing these people to seem like they have as much right to be pissed off as these people over here. I want to create a clear distinction between these two different groups of people, because I do believe one has a severe right to be pissed off, and the other has close to no right to be pissed off, because in my opinion, they are as literate as the people that work at the New York State Supreme Court. So we are going to dive into this a little bit. It says Swiss are on the hook for $13,500 each on Credit Suisse bailout. Taxpayer exposure amounts to 109 billion Swiss francs. Despite some public anger, risk of hitting the ceiling is low. So it says Switzerland's tab for shoring up its reputation as a financial center could run up to 12,500 Swiss francs for every man, woman, and child in the country. To backstop the emergency sale of Credit Suisse to its Zurich rival UBS group, the Swiss government pledged to make as much as 109 billion francs available, a hefty burden for a country of 8.7 million people. On top of that, there's a guarantee from the Swiss National Bank of 100 billion francs that isn't backed by a government guarantee, according to the deal announced Sunday evening. The combined sum of 209 billion francs is equivalent to about a quarter of Switzerland's gross domestic product and exceeds total European defense spending in 2021. The price tag for Switzerland's largest ever corporate rescue could add up to more than 3 times the 60 billion franc bailout of UBS in 2008. And to be clear, I understand why people are mad at this. I get it. When you have a bank that has just done the stupid shit that Credit Suisse has done over the years, whether it is any of its older investments, giving Bill Wang of Archegos back more of his money than they should have, given that Bill Wang is essentially a Wall Street bets meme lord in real life, they have made bad decisions. And when banks make horrible decisions, and they wind up either getting rescued or having these really good sweetheart deals made so that somebody else will buy them to keep them from collapsing, it creates this moral hazard where you're allowed to just do stupid shit because you know that somebody else will bail you out of your stupid decisions, which you bet your ass is never going to something that's going to happen to you or I if we have a bad business decision or investment when it comes to our small business or our finances. I understand the populist outrage here, and I understand why these people are mad. I understand the argument that you can't have the banking system collapse, but I tend to lean a little bit more on the side of, but this is not real capitalism. Again, like real capitalism is you do stupid shit and you fail. Anyway, this is not the point that I want to die on in this video, so I will get to the point that I do want to die on in this video. The renewed rescue plan for well-paid bankers sparked protests. About 200 people gathered outside Credit Suisse's headquarters in Zurich on Monday, chanting, "Eat the rich," and throwing eggs at the building at the heart of the city's financial district. We are fed up with the idea that if you're big enough, you get everything. And again, I understand why that guy's mad. Really do. I don't think that everybody there understands all the intricacies of what's going on, but I understand why he's mad. I get it. The part that I don't agree with is what comes next, where they say that the country's financial regulator wiped out about 16 billion francs worth of Credit Suisse bonds to increase the bank's core capital. We have to talk about those bonds. We have to talk about that 16 billion's worth of bonds that have been wiped out, because these are not bonds in the traditional sense. And I see so many news websites referring to this 16 billion in bonds that got wiped out as if this is such a moral outrage. How dare you? They should have gotten paid back. How could they not get paid back before the shareholders? That's not how this works. We're going to dig into that once we finish this article. On the 100 billion franc guarantee to SNB, there I see a somewhat limited risk. I see more risks in the 9 billion francs that the government is guaranteeing in terms of excess losses for Credit Suisse. The government's SNB guarantee would be partially covered by securities and bankruptcy privileges, which should ensure that even in the worst case scenario, it would be covered without the need to tap state funds, Aman said. Liability for the government-backed 100 billion francs would only materialize if there was a bankruptcy of the merged entity, he added. This is a real long shot at the moment. So you would not just have to have Credit Suisse go bankrupt, you would have to have Credit Suisse UBS go bankrupt in order for you to be on the hook for that, which is, again, a considerably smaller chance of actually happening. So I see a lot of people reacting as if $209 billion has literally just been given away. Again, when they say on the hook, this has not been spent yet. $13,500 per Swiss citizen has not been spent yet. Again, on the hook, technically, and it is a reason to be mad, but it is different from actually having spent it. Systemically relevant banks had to turn themselves into holding companies. This was supposed to facilitate a clean breakup and protect domestic retail banking operations. In theory, all of the parts would have been liquidated to prevent dangers to the Swiss financial system. But Switzerland's government decided not to implement the legislation and instead pushed for a merger. This evident lack of trust in its own rules could prove very costly for the image of one of the world's premier financial centers. And I agree. What I think has to be discussed are these $16 billion in bonds, because these AT1s that were written down as zero, that's actually working exactly 100% as they are supposed to. And this here is an example of people just not reading the fine print or even the large print when purchasing financial instruments. What's even weirder here are that a lot of the people complaining are not unsophisticated investors. They're people that work for serious financial firms. So this is very well explained by Matt Levine. He is a man who is much smarter than I, and I'm going to read what he says. After the 2008 financial crisis, European banks issued a lot of what are called additional Tier 1 capital securities, or contingent convertibles. The way it works is this. It's a bond and has a fixed face amount, which pays regular interest. It is perpetual. The bank never has to pay it back, but they can pay it back after 5 years, and they generally do. If the bank's common equity Tier 1 capital ratio, a measure of its regulatory capital, falls below 7%, then the AT1 is written down as zero. It never needs to be paid back. It just goes away completely. So the way this works is I can buy bonds from, let's just say, one of two places. I could either buy a 1 or a 2-year US Treasury, which gives me jack shit in interest rates, but I guaranteed to get the money back in 1 or 2 years unless the US government defaults on its debt or, the country ends or something, which since they are considered a safe instrument because the U.S. is not going to end as a country or default on its debt anytime soon, that pays a garbage interest rate. I get something, but not a lot. This is different. This is, I give you money, and if your assets go down a certain amount, this literally goes to nothing. Banks need to have a certain ratio of assets to liabilities. Assets can be just about anything. The business loans that you have that you're not really sure if you're going to get money back on, property that the bank owns, stock the bank owns, businesses the bank owns. If the value of these assets goes down enough and the bank has enough liabilities, meaning the amount of money that it says when you go to chase.com, it's in your personal account, these securities get written down to nothing. The entire point of this is that people are giving the bank money. They get a much higher interest rate than they will get when they buy a US Treasury. In exchange for that, you're dealing with the risk that if the bank's assets go down a certain amount, that bond goes to nothing. So let's just say, I'm just going to pull some numbers out of my ass here. So let's say that you have this AT1 security, you want to buy $100,000 worth, and it has a 7% interest rate. That means every single year, you will get $7,000. However, if the bank's assets go down a certain amount, you're not getting your $100,000 back. That's literally going to zero. Like you just lost that $100,000. It's gone. That is the price of buying a security that has a higher interest rate than everybody else. And nobody seems to actually know how these work. Now, again, if you don't know how the AT1 securities work, that's fine. You're watching a channel from a guy sitting in a scratched up lounge chair that talks about motherboard repair and empty real estate. But bankers should. Investment professionals should. And the amount of people that are complaining about this is absolutely insane to me. So when you just look at what this thing is even called, this is called a perpetual Tier 1 contingent write-down capital note. Perpetual Tier 1 contingent write-down capital note, as in this is something that gets written down in the case of an issue. You effing moron. So if you just read what these people are saying, like it's insane to me. In my eyes, this is against the law, said Patrick Kaufman, a fund manager at Aquilia Asset Management, who invests in additional Tier 1 AT1 bank debt. He thinks this because he made a bet that was risky and he lost. Another person, David Serra, founder and chief executive of Algebris Investments, said the move was a policy mistake by the Swiss authorities. They changed the law and have basically stolen $16 billion worth of bonds in a widely attended call on Monday morning. Stolen! It's literally in the fucking name, you moron! Perpetual Tier 1 contingent write-down capital note. The point of an AT1 is that if a bank has too little equity but not zero, the AT1 gets zeroed to rebuild equity. This is why Credit Suisse issued it. It's why regulators wanted it, and it would be weird to not use it here, in the words of Matt Levine, who has his head screwed on properly. As he says, you go to investors and you say, would you like to buy a bond that goes to zero before the common stock? And the investors say, sure, I'd love to buy a bond that could never go to zero before the common stock. And the bank benefits from the misunderstanding. This is something that used to happen to me a lot in the early days with just board repair. Like somebody would come in and say, my machine's not turning on. And I would say, it's $250 to fix your motherboard. And then the next day I would get a call saying, hi, did you replace my motherboard yet? And I'd say, no, we're still working on it. But by the way, since you said motherboard replacement, I just feel obligated to let you know that we're fixing your existing board, not replacing it. And then they'd say, you told me that you were replacing it. And I would go, well, no, I didn't say that. But if you could also look at the estimate I emailed you where it says logic board repair, and you could look at the ticket name where it says logic board repair, and they would be convinced that they were getting fucked over. They would demand to speak to the manager or the owner when that was me. Like, that was me. I was the one who dealt with them. I was the one who they were talking to on the phone, but they were convinced that they needed to talk to the owner because they were getting screwed by somebody because I told them I was fixing their board instead of replacing. It's just one of those weird things where even when it is in writing, it's just one of those very, very common industry misunderstandings. And it's one thing when we're talking about a $250 transaction regarding a 4-year-old laptop. It's another entirely when we're talking about investment professionals making decisions on how to allocate $16 billion worth of other people's money. You would expect a higher level of understanding here. And I think he's completely right. The thing that bothers me the most is you have people that have actual justified outrage at the fact that their government is backstopping the purchase of a bank that should be allowed to fail because they screwed up. I understand that. They should be angry. They did not ask for this. Versus people who literally asked to invest in this speculative security. They are the ones that agreed to this. Again, the people of this country did not agree. They did not vote to be on the hook for a UBS Credit Suisse bank merger. They did not agree to that. They did not agree to backstop any of that. They have a reason to be angry. The people that chose to invest in AT1 securities, whose literal name of it is Perpetual Tier 1 Contingent Write-Down Capital Note, you moron, has absolutely no effing right to be mad. And the fact that these just kind of get mixed together in so many articles that I read, oh yeah, you know, the Swiss are going to be on the hook for $100 to $200 billion of this. And these people got $16 billion in bonds wiped out. No, they're totally different. One group has the right to be mad, the other does not because they're dumb. This even happened 4 years ago, and he goes over it. One day, 4 years ago, Bank of Santander didn't call in its AT1s after 5 years, and the market freaked out. Santander's decision is raising questions about whether investors will start souring on AT1s across the board, said the Wall Street Journal at the time, which would force European banks to rethink a key way in which they have cushioned themselves against potentially catastrophic losses since the global financial crisis. And as Matt Levine says, I was unmoved. I wrote, if the regulators think that AT1s are equity and the investors think they're debt, someone is wrong, and it is much better for the investors to be wrong. Since then, I have become very convinced that regulators know how AT1s work and that investors don't, and that this is good. Yes, the investors had no idea how it worked, and the sad part here is it's not normal, average, everyday people that are complaining. It's the people that should know better. It's the fiduciaries. It's the people whose job it is to properly manage your money. These are the people that were putting billions and billions of dollars into securities that paid higher rates of return without ever reading the fine print or even the name of the security. This lets you know. Yet they continue to pour billions of dollars into a security that had a higher rate of return, whose name of it, whose basic contract makes very clear that if a bank has too little equity, but not zero equity, the AT1 gets zero to build equity. What is it that shareholders have? Equity. A shareholder in that bank has equity. Now, if the ratio of assets to liabilities goes too low, that is when these securities get put to zero. But it's not when the equity of the bank is zero, which is why the AT1s get paid out after the shareholders. This should be basic. The reason that they were buying AT1s instead of becoming shareholders in the bank is because it was more profitable in the short term to do so. It was more risky. You didn't have anything stolen from you. There's a reason that I bought U.S. treasuries at one point in time in my life rather than buying Credit Suisse AT1 notes. Because in spite of the fact that I got a lower rate of return, there was a lower likelihood of this happening. It doesn't say, if tax revenue falls below this particular amount, then you just don't get any of your money back. That's the price of having a higher rate of return. And none of these fucks want to pay it. And that's fine that you don't want to pay it, but you don't get to go on Bloomberg Financial News and bitch about it. That's it for today. That's my rant. That's about it. As always, I hope you learned something. I will leave a bunch of links down below to a bunch of different articles and pieces that I think people should read when I find anytime stuff like this happens. Now, I completely understand why it is that UBS wanted this level of guarantees if they were going to buy Credit Suisse, because the potential for there to be massive downside is greater than, it's one of those things where it's like, I could make this much money, but I could lose this much money, and I have 1 or 2 days to figure out what the chances are of this happening. So I'm not going to jump into this deal in 1 or 2 days without some serious support. I can understand why it is UBS was lowballing as much as they were and asking for these guarantees. And dare I say it, I could completely understand if UBS said, you know what? I'm not touching that shit for anything. I wouldn't buy that bank for $1 because you have to consider the fact that there is a very large chance of losing money. So when you take a look at Credit Suisse's reports, and again, when you look at their reports, you're trusting the word of people that gave Bill Wang back more money than he needed. This is a bank that went up to what is essentially a real-life Wall Street Beps meme lord and said, take more money. That is not somebody that I would consider trustworthy. This is like when you go on one of those real estate sites and every single one of them says your house is worth $500,000 and another one says your house is worth $2 million. These things can be wrong. But when they filed their annual report, Credit Suisse said that they had about $486 billion in liabilities and $531 in assets, which means that you have $45 billion of shareholders' equity. Now, the stock market looked at this, and the stock was trading that week at $224 a share, which makes the market cap $9.7 billion. So the stock market, the investors themselves looked at this and said, there's no way in hell this is worth $45 billion. We think it's worth 9.7. That's what the market cap is of a company. You have the company's assets minus their liabilities, which is what the company is worth, and then you have what the market actually thinks it's worth. These are always going to be a little bit different. The stock market thought that this bank was worth 5 times less than what the bank was actually saying. So this is not crazy. I mean, it's not crazy if normal average investors are looking at this and saying, you know what, you think you're worth $45 billion, we think you're worth closer to 9. Then it is completely normal for somebody else looking at the fact that this is a bank that is in distress, that has spent money stupidly to go, you know what? I don't even have 80% rate of distrust in you, because 80% rate of distrust is the going rate. I have 95% worth of distrust in you. I don't trust you worth shit. If anything, I could understand UBS saying, we're not buying this bank. We want money in order to take it. Because you're talking about them. When you really think about it, they're claiming, UBS is saying we have 531 billion Swiss francs of assets. But if the market only values them at 9.7 billion, that's the market looking at this and saying, you know what? We actually don't think you have 531 billion in assets. We think that you only have 495 billion in assets. Well, what if it's off by more than that? What if What if they only have $450 billion in assets? That would mean that UBS is spending $1 or $2 or $3 billion to lose $30 billion. They may be spending money on something where they will lose money, because you have to think about how it is you value an asset. When you're just talking about a house, look at how far off Zillow can be on a house. Zillow can say that a house is worth $800,000, and then you ever see that with like Zestimate $800,000, and then you scroll down and it says 3 months ago it sold for $500,000 in a hot market? That's because Zillow was wrong. Now imagine not having to do that once, but having to value an entire bank, which is going to own businesses. It's going to loan loans that businesses may or may not pay back based on their creditworthiness, that UBS may use different instruments to gauge than Credit Suisse. It may own cars, houses, all the different things that this bank owns. UBS is going to have to figure out whether or not 531 billion Swiss francs of assets are actually worth $531 billion inside of one weekend. No. There are housing appraisals that take more than 2 days to do, much less appraisals of $400 to $500 billion worth of different assets, different derivatives, different loans, different businesses, different cars, houses, everything else that a bank owns. And when you're talking about a bank like Credit Suisse, you bet your ass they're going to round down. I don't blame UBS for saying, I'm not buying this steaming pile of shit unless you guarantee that I am not going to get completely fucked. Especially if you're saying that we have 2 or 3 days to decide on the deal. I understand that, and I completely understand them saying, if you want me to buy this immediately, I want a discount because I don't have time to inspect it. The same way that the type of person that's going to buy a house sight unseen is typically going to spend less money on it than somebody who takes 2 to 3 months because they don't know what they're getting themselves into. I understand what UBS did. I'm not mad at UBS. I would be mad at the Swiss government for giving them what they're asking for. And I would be mad at the Swiss government for putting the Swiss taxpayer on the hook for it. And above all, I'd be mad at the idiots that ran Credit Suisse the way that they did to begin with. I understand why UBS pushed for the hard bargain that they did. There is a good chance that they will make stupid amounts of money off of this, but there is also an equal chance that they lose insane amounts of money because of this, and that they are on the hook for all different types of liabilities, and that they cannot pay off with their assets because their assets are worth shit because they were valued by Credit Suisse, who were a bunch of morons to begin with. It's not their fault, in my opinion, for pushing for a hard bargain. It is the government's fault for even pushing for this merger to begin with. If UBS says, listen, I'm not touching your mess unless I'm getting a good deal, that makes sense for UBS. What doesn't make sense is for the Swiss government to say, you know what, if something goes wrong here, here's a bunch of money in case a bunch of things go wrong. Will you make the deal already? That's the part that kind of gets perverted here. So yeah, that's about it for my rant. I think that the people who were pissed off at this happening have every right to be. I think the people that are crying over the $16 billion in bonds that got wiped out, I mean, it sucks to suck. You're a financial investment professional, and you didn't even read the title of the security that you were purchasing. I don't feel bad for you at all. I don't think anybody should feel bad for those people. Feel bad for the Swiss taxpayer that's on the hook. By all means, feel bad for the future moral hazard that this is going to create, because you bet your ass there's going to be a lot of people doing even stupider investments now they know that they can get away with it. But don't feel bad for the AT1 bondholders. Like, you could have bought something else. You bought that because you wanted a higher rate of return. Sucks to suck. I don't know what to say. That's it for today. And as always, I hope you learned something. I'll see you all in the next video. Bye now.